Good evening, everyone. Welcome to Admiral Markets. My name is Chris, and together with Nenit, we're going to take a look together at tackling drawdowns and risk management. So, very important topic, and looking forward to present to you our thoughts, and looking forward to hear your feedback as well through the chat. Before we start, though, be aware that this webinar is intended for a global audience and may not be suitable for everyone. Please seek advice. No, actually, sorry, that's the other disclaimer. To get the corresponding information on charting conditions and other details, visit animalmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out if it is suitable for you. Also, trading for exchange and global financial markets is considered high risk and may not be suitable for all investors and traders. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only, and by continuing watching this webinar, you agree with this disclaimer and you're aware of the risk involved when trading. Alrighty. So I hope my sound is okay and will be better than last week, and that you'll have a good flow here of the audio. Let me know if that's okay, please. That would be great. In the meantime, just want to introduce the fact that Admiral Markets is the organizer of this webinar, and Admiral Markets had very good news yesterday, in fact. First of all, though, be aware that you can take a look at the Supreme Edition, a lot of good stuff. But the good news is that Admiral Markets is the winner award for the best MT4 broker in UK. I think it's in the UK that the award was given. So thank you, first of all, for your vote. Really appreciate that, and the fact that you made Admiral Markets win this contest means a lot. So obviously, very happy about that. It's very cool stuff, and maybe Netta will still talk about that as well later on. So just wanted to let you know that Admiral Markets won that award. So that's a great thing that happened yesterday. You can tell your friends and family that you're all trading at a very good broker. So risk management, that's our topic of today. And it's vital because basically it allows us to trade the next day and the next week and the next year. Because without risk management, there's basically nothing stopping us from losing everything we have in our trading account, and perhaps more in worst cases. So risk management is what keeps us basically the ability to play our edge and survive drawdowns. Because if we don't have risk management, the drawdown would basically whack our account. If we're risking, if we don't have any risk management, then we're risking 20, 30, 40, 50% on one trade, or everything on one trade, then any one loss would lead to the fact that the account is gone. So what does that mean? Well, that means that we can't survive a drawdown, right? The whole fact of the matter is that we always will bump into drawdowns, some kind of losing streaks, basically, series of losses. And we need to be able to survive that so we can continue to trade. Now, if we can't survive drawdowns, it's, in other words, basically gambling. So risk management makes that distinction, makes us traders, in fact. Very important, you probably know that, and it's good that you're here. So goal number one and number two is protecting capital. In both cases, a bit different. One is trading capital, the capital we use to trade, and also very important is mental capital. Because if we're too mentally exhausted, that could first of all lead to losing capital. If we're fatigued and we're trying to revenge trade, we can lose more. But also we need to make sure that we have a balance, that we're not sitting at home worried about the trade because we have too much risk on it. It would just eventually eat us really psychologically from inside. So we need to be able to turn off and be able to live with our decisions. And that's why mental capital is important too. So we need to have a risk plan, obviously. Not everyone has that. And if we have it, then we need to follow it. It's really that simple, but in reality, it's not that simple. It's simple on paper, but doing it is a different matter. So we'll talk about how we can do that and try to not break the rules and try to adhere to that plan. First, let me talk a bit about risk plan. I guess there are a lot of ways you can approach it, but what I like to do is I like to cap the risk per unit of time. So that depends how you trade. If you're trading a lot within the day, you want to do a daily limit. If you're trading swing trades, you might want to think about a weekly limit. But we'll talk about that a bit more. Then within that limit, you have a certain boundary that you want to adhere to. Then within that boundary, it's okay to take risk because we don't want to see trading as something that the fact that the risk taking is bad. Risk taking is good. There's nothing wrong with taking risk as long as it's within your boundaries, as long as it suits your psychology. That's good. And our focus is to trade that next day, to survive those drawdowns, survive those emotional drawdowns as well. So those are the goals. So I don't want to create like the impression that the risk management plan should be something that totally takes away all risk, because well, if all risk is gone, we would be trading demo and we would not be able to make money. So there are two sides here. One is indeed, yes, we want to be careful, but one is also the fact that trading is risky, and there's nothing that we can necessarily change about that. It's good, in fact, because it allows us to potentially capitalize on that risk, and it allows us to gain from that opportunity. So that is a positive side. It's just we need to approach it with a certain balanced attitude. So we need to be happy with the fact that we can take risk, but then again also have a boundary where we say no, not more than this. So we need to find that balance between the two. So for instance, what we can do, for instance, is say, okay, we have a max risk per day. That could be 3%. It's just an example. It really, the level that is good, it depends on you, what you feel comfortable with. Now, obviously, I wouldn't recommend 50% per day. That's going into a very extreme. I wouldn't necessarily recommend maybe too low either, unless you're maybe starting, relatively beginning trader, then something low is good. But you want to find a balance that allows you to gain, allows you to earn, but still feel comfortable with what you lose. So let's say 3% in a day, just as an example. Then within those 3%, within those 3%, you can chop that risk into smaller parts and trade, in a way, as many trades as you want to, as long as you don't hit that 3%. If you want to chop that 3% into 20 parts, you'll be trading very small units, but you would have to have 20 losses in a row before you hit that 3%. So you can really trade a lot, and you're not going to hit that max risk. So you have a lot of chance to survive the drawdown. And next time, even if you hit those 3%, you still have 90%, 97% left to trade tomorrow. So you can see that you're limiting yourself, but also allowing yourself to trade. You're giving yourself breathing room as well. So one way is to decide how much risk you want to take is by either going back into your history and taking a look at how many losses you've had in a row. That's one thing. Or if you have back testing, take a look at how many losses you've seen with back testing. Decide about how much risk, how much loss you want to accept, and then divide the two with each other. All right. So, for instance, you're okay with taking a 15% drawdown. Historically, you've seen a couple of times that you had 8 losses in a row. So you decide to take 10 just to give a bit more space. This drawdown could be, for instance, per month. Depends what type of trader you are. Let's say you don't want to have a bigger drawdown of 50% in 1 month. In 1 month, you typically don't have more losses than 10. So that way, from that point of view, you can risk 1.5% per trade. All right. Depends how aggressive you want to be or how conservative you want to be. If you really don't want to hit the max in a month, you could opt to change the 10 into 20. if you do see occasionally that you hit 10 losses in a row, but you decide that you don't want to run into that problem, you might decide to say, okay, I'll make it 20. You give yourself even more breathing space, even more leeway. You'll be risking less per trade though, 0.67%, let's say 0.7%. So less risk per trade, but you'll bump into that. You will bump into the max loss, max drawdown less often. So there's a positive and a negative there. When trading, let's say through intraday trading, or even intra-week, it doesn't matter. Don't approach trading in such a way that you're putting a lot of risk on any one trade, in my opinion at least. Sure, I mean, if you are a long-term trader, you're going to have to put a bit more risk. Typically, you'll be putting more risk on a trade because there are less opportunities to trade. If you're looking at a daily chart and you only have a couple of trades a month, then if you only put 0.1% risk on, depending on your capital, but you might not be earning quickly enough for your standards or for your goals. So, but that depends. But in any case, in general, especially if you trade a bit more frequently than once or twice a month, then typically I like to spread the risk over multiple trades, because why put a lot of risk on one trade? It makes the whole trade very emotional. So you're very anxious about that trade, which means that it's difficult to follow your trading plan. If there's a lot of risk on that trade, it's a lot easier mentally to say, okay, I risked 10%, I'm up 5%, I'll grab that money. But at one point that's going to go wrong, because unfortunately, one point the trade is going to end up in a loss, and that loss is going to be a lot bigger than what you win. That's the danger of aiming trading with a lot of risk on one trade, where if you have low risk, you're not as emotionally attached to that trade, easier to follow the trading plan. Plus, if you do lose that trade, you can still trade a second and a third time and a fourth time without getting emotional. You allow yourself to come back. Very important, I think. And you stay flexible. All right, and you're less emotional. And you don't stop yourself from good opportunities, because if you hit your daily max, if you hit your monthly max, that means that trading should be over. You shouldn't continue, because that's in your rules, and if you do, you're breaking your rules. But if you don't continue, obviously there's the disadvantage, what you should do because it's in your rules, but the disadvantage is that you cannot access those opportunities anymore. So it's good to have a max, but preferably we don't hit that max, right? Obviously, because then you might lose good opportunities that do arrive. So depending on how you trade, I mean, you can decide to put a risk per day, per week, per month, even per day and per week, or per day and per month. I mean, depends. If I have a risk per day, then typically the max risk per week would be something like 4 times what I have in a day. 4 times that daily amount. I mean, I wouldn't want to go more than that. That seems already very extreme, in fact. But okay, if it were to happen, then you really want to stop there. But that's already it would be really quite wacky week in that case. But all right. Anyhow, let's see. Common or max number of losses per day or week. That's another way of doing it. So, for instance, you could calculate the risk that you take per trade by saying, okay, what is the max number of losses in a day that I regularly encounter? Let's say I want to risk 3% per day, and sometimes I have six losses in a row in a day, or 5. Then you say, okay, I want to have a bit more space, so I say 6 trades. Or you don't encounter 5 losses in a row that often. So in this case, you're pretty safe with 0.5% risk per trade. And the chances that you'll hit that max are not too high. So that border, like, do you want to have a high risk? Sorry, I should say, do you want to have very little risk of hitting that border, or do you still want to have a bit of risk that you can hit that border. It depends how aggressive you want it. If you want to be aggressive and you want to keep that percentage risk per trade high, then you're going to hit that border quicker. If you really don't want to hit that max per day, then you're going to risk less per trade. Risking per basically diversifying the risk by trading different pairs and by taking different trades is a good thing, but you want to be careful. I mean, personally, I wouldn't suggest or recommend having too many trades open. I think if you have really a lot of trades open, let's say a wacky number of like 30 trades or something like that, there are some traders that do that, like, I don't know, about 30 perhaps, but a very high number, because they have kind of like a portfolio style. They have more of like a hedging style, perhaps, a basket kind of trading, which I think does, in a way, help with the psychology, because you got so many things going on. You know, you're just kind of implementing and executing. You're not kind of dependent on one trade, which is a good thing. But I think that it does require a lot of disciplined approach, because you have to be very secure and very precise about what's going on with all those trades. It's difficult. I personally don't do that. It's not impossible, though, I guess. You got to be very careful with your leverage and your margin, and make sure that you're taking small risks so you don't encounter any problems with that. But personally, I think that 2 or 3 trades open at a time is better. If you go up to 5, it's already, you know, depending on how much risk you're taking, it could be a lot of risk. If you're risking 2% per trade, you get 5 trades open. Whoa, that's already 10%. That's too much, I think. On any, you know, having 10% open at any point in time is a lot, right? It's too much. Unless you're really taking risk on purpose. You have a small account, a mini account, and you just want to take a lot of risk. Well, then that's a different purpose. It's a different goal. But if you have an account that's a serious account that is not intended for high risk trading, but just like a proper trading capital account, 10% is a lot, right? And you don't want to do that. So if you're risking that much, 2%, then you don't want to have 5 trades open. If you're risking open 2% per trade, then maybe that's a bit different story. And then indeed, you can use different pairs to diversify that risk. And you can spread your risk on a dollar pair and on a yen pair, and make sure that indeed you're not trading only dollars, like AUD USD, Euro USD, Pound USD, Dollar Yen, and Dollar CAD. I don't think there's anything wrong with trading 2 or 3 dollar pairs at the same time necessarily. But I mean, if you're only trading dollars and you're doing that 8 times, that could be maybe not so efficient. So the long term, I mean, if you're, no matter what the result, winning, losing, you want to adjust the capital, which you're of course using as a base to calculate your risk. Yeah, I think that once a month is okay. And if you want to increase that capital, I think again, once a month is okay. Withdrawing profits, of course, is important. Be careful of news events. I mean, these are all logical things, but I still want to mention them. And when you're thinking about targets, always think about a risk. It's so easy to focus and get distracted by how much we can make, how much we want to make in a year. But think about the fact that whatever we want to make is connected to a risk percentage and a volatility. And always consider whether you're ready for that type of volatility. Can you indeed live through a 50% drawdown? Realistically, right? Probably not. It's a lot. Not many can. So you might want to be careful with aiming for 60% in a year, unless you're very experienced and you can make multiple rewards out of a drawdown. Let's say you can earn 4 times as much as your drawdown. Well, then that's a different story. But at the beginning, we should expect a 1-to-1. Whatever we're targeting is what we should expect in drawdown. Right? So if we're targeting 20%, we should expect a 20% drawdown. So most traders, I think 20% is still okay. But more than that, it already gets a bit nervous, I think, for most traders. Maybe even 20% is too high for you. Maybe it really depends from trader to trader. As you can see, you got to get a number that suits you and meets your psychology, meets your potential, your goal of your account as well. All right, so you can take a look at risk management numbers. They're important too. I don't want to make it boring for you, and I don't want to, discourage you with statistics and some figures here, but they are interesting and I think important to have an idea about your trading. First of all, it's a T statistic. That calculates the luck, the factor of luck, versus how much you're actually earning through a systematic approach based on your analysis, based on your strategy, based on your edge. And that's a fascinating method, fascinating number, because it shows so precisely, I mean, it shows in one figure, one number, whether what we just achieved, whether the profit we made, is that really just based on a lot of risk, or is it based on something sustainable, and can we expect that to continue? So yeah, I think it's a fascinating number. It's a very important number, and if you find that just as interesting, send me an email and I'll send you how you can calculate it. I don't want to. It's not very long, but there is some steps involved, and I didn't want to bore people who are not interested in it. So if you're interested in it, just send me an email. You should see it in the chat. And anything basically above 2 is long-term sustainable. The higher, the better. If it's 3, wonderful. 4, great. If it's 5, hallelujah, it's perfect. 6, 7, 8, whatever. The higher, the better, right? But 2 already is sustainable. Basically, what it calculates is that if it's high, then the randomness around your result is not as high. That means if you would do your strategy again 10 times in a row, you should, in all 10 cases, get about the same result as you did the last time, the first time. Whereas if the T statistic is low and you do it 10 times again, the results are there's a very big variance in what you can see. One time it could be +1, the other time +10, maybe the other time -20, which means it's not as stable and sustainable. And there's just a lot of differences, different outcomes you can see. So the fact that you hit +50 that time was just lucky in a way. That's what it calculates. So anything between 1.5 and 2, it's kind of like a gray area. It's but anything below 1, 1.5 is it's not looking that great. So you have to investigate how you can how that you can actually play it out into numbers and see how, if you change the outcomes, how that can change, and then you can try to target and improve your trading like that. You can do actually a re-engineering and say, okay, if I had only risked a lot less on these trades, what would the outcome be? And maybe this strategy is not good enough. It could be also one of the explanations, or maybe we're over-risking in certain trades. That's something you can investigate. Right? Sharp ratio is a well-known one. Some of you will know it or recognize it. Basically, you're looking at the return versus volatility. But the Sortino ratio actually does the same, but ignores the positive outcomes. So what it says is, I don't care about if your positive outcomes are very, very high. That's good. Why would I punish the strategy if some of the results are extraordinary? That's good. I'm only going to look at the variance, the big differences when I lose to the downside, which makes sense. So I like the Sortino one, because why would it be bad if I made plus 20% on one trade? It's good, right? But it's, according to Sharp ratio, there's a high variance. So Sortino only looks at the variance to the downside, which I think makes more sense. Alrighty, then of course there's the psychological point of view. The rules that we have versus the psychology, implementing a risk plan. I mean, at the end of the day, this is actually why we burn an account, really. Unless we don't have a risk plan, but I think most of us do, then it's not about having a risk plan, it's about following it, really. I mean, that's what that boils down to. So why do we not follow a risk plan? Maybe because we don't have enough space to trade in a day. If you have 2 losses and you have to stop already, well, you're not giving yourself space to trade. And you can get annoyed and you can continue trading because, well, it's maybe not a good plan. It's not maybe a very logical plan. And it's maybe not so strange that you break it eventually because you're not giving yourself enough breathing space to take a risk. So you want to have a good plan that you feel comfortable with, so you increase the chances as much as you can that you actually follow it. If you trade twice and you lose twice and you have to stop that day, well, I'm not saying it's good, but maybe not so strange that you actually try a third trade, right? So make good rules makes it easier to follow that plan, because at the end of the day, the sole reason why accounts are totally lost or large parts are lost is because we're just not following the risk plan. We start to increase our risk, we increase it because we want to win it back. We're hoping for a miracle. Unfortunately, before we know it, you got 40% loss, 50% loss, I don't know, how everything is lost, just getting emotionally like a roller coaster, spiraling out of control. We gotta avoid that moment that we lose control. We gotta be risk takers, but within the boundaries. It's yeah, as I said, it's simple but not easy. And it's that simple, really. It's just we have to do it day in, day out, and never have a weak moment, and never allow us to break those rules. We have to really that iron discipline, never to let that happen. Because if it does happen, yeah, it's back to the drawing board. Either it means stopping trading, or it means fueling with new capital. It's emotionally heavy to accept the fact that we broke the rules with that outcome. So it's tough and tough to come back. So we have to find that balance. Don't fear losing one trade. But we don't want to, of course, also don't want to fear losing the max day loss either. And we don't want to be detached of losses either. So what I mean here is that one loss, we should be okay with losing because it's going to happen. And if we're annoyed with one loss, well, that's not how we're supposed to trade. One loss should mean nothing to us, nothing. But then again, of course, we also want to make sure that when we lose, let me say it this way, we don't want to be detached of it. We do want to make sure that we trade properly. What I mean with that is that the amount we trade shouldn't be so low, perhaps, that we don't care at all, or let me say it this way, that we start doing wild things because, it's only this much, I will gamble. So you want to take it serious, but not fear it either. That's what I mean. So it's our duty to find rules that we can listen to. So iron discipline is one of those things that is going to be needed. And the problem is that we can have it 95% of the time, 98% of the time, but we actually need it 100% of the time. And our goal is to trade tomorrow. Every time we start trading at the beginning of the day, write on a piece of paper somewhere in front of you on a board, I want to trade tomorrow. Make that the goal. Because if we start out with the day thinking, I want to make I don't know, you name it, how much money. And we're shy of that, we might psychologically start forcing ourselves to break those rules. If we can calm, relax, at that moment, keep the control and say to ourselves, okay, I'm down, but I'm going to close with 2% loss today because I want to trade tomorrow. Maybe then mentally we're strong enough to force ourselves to stop that day and accept it. But knowing that tomorrow we can start fresh again and we can continue to trade tomorrow and don't have a 50% loss. Maybe it's a part of the ego. Maybe, you got to find a trick that makes you disciplined enough. Maybe the trick could be to not be your own boss. Make yourself be responsible to someone. You have to explain what you did. You have to explain your actions. Talking to a third party is a lot more difficult even than explaining it to yourself. We're, I think, easier forgiving ourselves than if we have to explain our trades and why we took that risk and why we broke our rules to someone who's a third person. When we mentally, even if it's just mentally, but preferably someone who's really that person who's there for you, that it's just a different story if you have to think about the fact that there could be someone who's like your boss, and you have to explain that. I'm not sure if I understand your question, Vinay. What do you mean if you say bias? To buy is something to purchase, and then you say biased. You mean like BIAS, like a bias to have a bias in that regard, maybe? So it's your duty not to break the rules. Well, I'm not sure what you mean with iron discipline. What I mean with that is just the ability to follow your risk management plan day in, day out. It's nothing fancy, but apparently it's very difficult, or it's at least not. At least it's not something easy, because many people unfortunately bump into the problem that they have substantial losses on one day, on one trade. Why, right? Why take that risk on that one trade? Why not spread it out and let the law of your edge work out on a larger series of trades? That will give a lot more information, make it a lot mentally easier, and will increase the chances of making profit a lot more. That's what I mean with discipline, to be able to do that. Because at one point, the fact that we break the rules is lingering around the corner. So make the rules comfortable and live to those boundaries. That's what I mean with iron discipline. Alrighty, folks. Well, that's my 2 cents on the matter. Very important. Let's see what Nena will present to us. I'll pass it over.
Thank you, Chris. So I will continue with webinar. Definitely, drawdown is something we all have during our trading career. So the problem is that you should never ever allow anything to happen to your account if you're not. Let me see. Questions are here. Okay. If you're not focused on your trading, primarily on your account, it will suck your account into a spiral of doom. Now, drawdown will always exist, guys. It will always exist no matter how good you are, especially if you trade multiple accounts. At this point, I trade 4 different accounts. I have one big account, I have one scalping account, I have one very small account, and also I have the account which is used for bigger risk. So 4 different accounts is something where it's very hard to tackle from time to time. But the main problem is, are you ready to take the risk? Are you ready to accept that there will always be drawdown? And later, during the webinar, I will use slides from one of my accounts to show you how some mistakes can be very costly. Fortunately enough, I have managed to cope with the drawdown. But the thing is, even when professionals are trading, every single time you need to be ready to accept a drawdown, be it because of your hardware failure, be it because of your psychological mistake or risk. There is always a mistake which will cost you a drawdown. So be ready for that, be prepared for that. But that's something really which is very easily tackled if you know how to deal with it. Even if you lose a lot, it's not a problem, because losing is also part of trading. So guys, be ready to accept the truth, especially if you want to, I always say that, building up the account, because it's easier to trade $10,000 at least than it's, I don't know, $5, $6, or $100,000. But the thing is that if you're ready for a challenge, and if you're ready for an iron discipline, you should always start practicing with $100 account. For example, the last account which me and Chris were working on, it's basically something which we will be using for a HARP system. We started with $300, and at this point, it's something like $670. So it's not much, right? $300 when you talk about money, it's not much. But the thing is that it's double. We doubled the account. So we actually made 100% of the account of our HARP trading account. Now the thing is, we are professionals. We know how to deal with drawdowns. We know how to deal with where can be potential mistakes, what the risk reward we should use, whatever. So it's not always guaranteed. It's not always guaranteed. But the thing is, well, definitely when you apply a whole knowledge, the overall knowledge of price with other things such as market fluctuations, equities market, whatever, when to trade, when not to trade, then it will yield the result. Now, let's get back to drawdown. Drawdown is basically, I call it personally retracement in balance chart. I will show you that later from my live trading account. There will always be ups and downs. When you see the account which goes straightly like this, it's not okay, guys. Something is not okay. Because even the best traders, even the best systems, the overall most successful analysts and traders will always show a curve in their accounts. Because if the account goes like this, okay, there is always that drawdown which is not visible. But you can always opt to see if there was a relative drawdown, maximum drawdown. So there will always be some sort of drawdown, right? It's very hard to maintain a constant spiral. Now, I can manage with one of my accounts. It's 3-year-old account, and it's good. It's looking good. It's something like 50% in a profit, even with all sorts of mistakes that I have made. Now, I'm not particularly talking about mistakes from trading point of view. For example, very often it happened that I forgot to put stop loss, not because I don't want. I always trade with stop loss. But when you tackle 4 different accounts, it's sometimes, you know, you're very tired and you just forgot to put stop loss for a trade. It's sometimes. It's not very, very often, but sometimes. But it's one of most common mistakes, forgetting to put a stop loss. So you always need to pay attention to that. It's not hard, especially if you do trading on a single account. Or sometimes, let's say, my last mistake was forgetting to delete a pending order. So mistakenly, I put a pending order while I was doing the analysis, and I didn't see it, and I forgot to put pending order, and I suffered a huge drawdown from that. I will show you that. Don't worry. So those are some mistakes. So drawdown will exist, but there are always limitations versus future risk. So always take into account a future risk. Learn from your own mistakes. Okay. This is basically a picture how maximum drawdown looks like. So the angle between the equity and the maximum drop is a maximum drawdown. We always need to remember that there is historic drawdown. Okay, that's called maximum drawdown, historic drawdown. Okay, so that is the drawdown which has been highest to the peak on a single account. Okay, so look at this, for example, a representation of account. So you see it's maximum drawdown, it's 50% at this time. So at this time, this account shown 50% maximum. Now at this point, it's 20% of drawdown. Okay, but now think logically. What is maximum drawdown for this account? Is it 20 or 50? Okay, the answer is very logical. Maximum drawdown for this account is 50, because at the start of trading, a trader has suffered from 50%. Now that will be a historic drawdown, but as everything is written in history, right? Also our account writes itself in a history, I can say, cheat sheet. So this will always be remembered, this account will always be remembered as having 50% drawdown. It doesn't matter, this is great trading, right? Okay, good, it goes up, then it goes down, so it's good. This is not much, 20%. But the thing is, historically, it showed 50%. Now, it doesn't matter that this is bad, but the point of this, do not be afraid of the drawdown. You just need to know how to manage it properly, okay? Now, there is also profit to drawdown ratio. For example, a performance that shows a 30% of profit after a 30% drawdown should be considered better than a performance that reaches 40% of profit after 80% drawdown. Remember this. My account shows, Camarilla MACD swing account, shows 21 or 22% of drawdown with 52% of profit. Okay? So you should always pay attention to that. If that is the case, then something, guys, is not perfectly right with your account. Okay, something is not functioning very well. Equity curve is not that good, and you need to ask yourself whether your strategy is maybe is bad for you. Maybe it's bad for you. Maybe it's not the best strategy, but you just cannot comprehend it. So maybe it's time to switch the strategy. So 30% of profit and 30% drawdown is okay, but it's much better than the performance of 40% profit after 80% drawdown. A lot of accounts will show you this. Really, a lot of accounts. Then losing streak. Don't be afraid of losing streak. If you are always within confines of risk threshold, you should never be afraid. I always tell you guys, 5% threshold is your maximum. If you ever cross 5% threshold, you're in danger zone. Okay, I will always repeat, you can gamble, you can go with 20% risk. But only if you're ready to gamble. If you're not ready to gamble, if you want to trade patiently, if you want to trade without the stress, then 1% maximum per trade. Macro or microeconomical risk always present the biggest nemesis for your account. Just remember what earthquake in Japan did several years ago, what Swissy floor break did some time ago. So just remember that. Okay? Macroeconomical risks are always the biggest threat to your account. Vinay is saying, sir, my account showed a profit of 10 after a drawdown of 50%. No, it's not good, Vinay. At least aim for I can say equilibrium between profit and drawdown. 10% of profit after 50% of loss is not good. So always aim for at least equilibrium. Okay, 40, 60, but it's not that good. It's always best to have bigger profit and less drawdown. Always. Jeremy saying China. Indeed, China also. Now it's a problem with China. We had Greece. Now Greece problem has been solved. Now we have China. We will see what will happen. But at this point, it is a problem indeed, because China problems are reflected on equities, and equities are reflected on forex market. But the excess risk should be dealt with. So you can see markets have been calm last week, and especially now calm before FOMC. Of course, trading FOMC will be a huge threat to your account, so I don't recommend it. Also, there is so-called risk management. So if your starting balance is 10,000, you use 5% of risk, so you're basically trading with $500 risk. So that is why I'm saying, guys, even this is not okay for your account. Try to trade with 1% of a risk. I know it sounds crazy now. A lot of people would say, okay, I have $10,000 and you're telling me that I should trade with 1% of risk. Well, guys, I've been there. I know what I'm talking about. Once in a while, you will see, if you cross this 5% threshold, you will remember my words. You will remember Chris' words. You will remember what we have been saying to you. And then you will say to yourself, okay, why didn't I listen to them? It's not empty talks. It's not anything which has to do with snake oils, with cheats, with unfairness, with all sorts of trading nonsense. We're always telling you from our experience. And yes, Jeremy, if you want to risk 2% per day and you want to make 4 different trades, then use 0.5 risk. If you want to take 2 trades, then you can risk 1% each. So do not cross 2 or 3% per day. It's not one trade. You can make a couple of trades. And always save for a recovery. Okay? Always save for a recovery. For example, if you open 1.0, 1.10 lot size, 0.10, then if you lose that trade, you can still cover with, let's say, 0.20. But that should be in overall 2% of a risk. That is how I do always. And that is why our accounts and my accounts are successful. Because I trade with lower risk. My first trade is always lower risk, always. And then if I lose the trade and I want to make another trade, I still have enough space to use double the recovery, but without risking more than 2 to 3% overall risk. So start with 1.5 to 1% per trade, and you will see how your account will be grateful to you. Okay, definitely. I know what I'm talking about, guys, because I'm also a trader, not just an analyst. Okay, and you have witnessed session recap setups, Camarilla MACD setups, which I have been providing you with. 80–90% of the time they're successful. Now, if we get in a drawdown, which is normal, we need to tackle it. We need to know how to handle it. How to handle drawdowns. If something is not correct, if something is not good, guys, change something. Always change something, okay? Because if you're having 10% of profit with 50% of drawdown, then something is not right. Change it. Change the strategy. Visit our webinars. Read our analysis. It will help you. Reduce your lot size. Adjust the risk. Yes, the primary thing in Forex market is money management, right? So if your account, let's say, is, for example, let's say $5,000, and you can go with, let's say, 1% of risk, and you open 0.1 lot. If you lose this trade, You can still go with 0.2 lot and let's say take 2% of risk for an overall 3%, but not per trade, 3% per day. Because when you open a trade with a particular lot size, you need to know how big is your risk. Your risk should always be fixed. Okay? Your risk should always be fixed. It doesn't matter if you use 10 pips stop loss or 100 pips stop loss if your risk is 1%. Instead of opening, let's say, 0.3 lots, you would open 0.05, right? It doesn't matter the amount of your stop loss. It doesn't matter. Stop loss is just stopping your loss. Remember that. Forget about other lecturers, what others people are saying. Sometimes your stop loss will be 30 pips. Sometimes your stop loss will be 50 pips. You cannot always say my stop loss is always the same. It's stupid. How can your stop loss be always the same? Price is not always the same. Price goes up, goes down, goes up, goes down. You need to know how to read the price. You cannot, no one can tell you, okay, my stop loss is always 30 pips. It's nonsense. Let them trade GBP New Zealand with 30 pips stop loss. Let them trade Euro New Zealand with 30 pips stop loss. Pound Yen with 30 pips stop loss. Pound Swissy with 30 pips stop loss. It's impossible. Range of Pound Swissy, Pound New Zealand, Euro New Zealand is triple the majors range. If Euro Dollar is making 100 pips per day, Euro New Zealand will make 300. And GBP New Zealand, and GBP Swissy, and GBP Audi. You cannot trade and treat every single pair the same. And it's not important, because the only thing which is important is your risk. As soon as you open a trade, you already needed to think about your risk. If you're using a stop loss of 50 pips, then you need to open a lot size according to that 50 pips. If your stop is 100 pips, then lot size would be definitely halved from this 50 pip initial stop loss. That is why I always open my first trade with a lower risk. And if this trade is successful, if I open another trade, I will open with the same risk. And especially I have one account which I'm building, it's HARP account, and I need to make 5 or 6 trades per day. So once I open and that trade is successful, the next trade will be the same, and every successful trade will use the same risk. The only thing when I raise my risk is if I lose the trade. It's not raising the risk. I'm still within the 5% risk threshold or 3%. But the thing is, I am able to trade. For example, if I lose a trade with 0.10 lot size, thanks to my risk management, I'm able to use next trade with 0.20 to recover this, but still having 2% of overall risk per day. It's something which you need to calculate based on your equity, based on your balance, based on your strategy. It's up to you guys how much you will risk. Find the risk balance point. That's important. Find the risk balance point. What is a balance point? If you reduce the risk, you miss the recovery. If you increase the risk, you may suffer even more drawdown. The wisest thing is not to interfere once. Okay? Try to repeat a winning pattern and you will succeed. Assess your own psychology. If you're a gambler, then you should definitely consider having a bigger account, where if you're a gambler. If you're not a gambler, then do it professionally. Avoid typical newbie mistake. And Jeremy is saying a good thing. How can one stop jumping from one system to another as it has affected my trading risk? Well, it's your psychology. It's your psychology. Give one system a chance. Try to trade it 3 months on demo account as you would trade it on live account. Or if you are very successful with demo, try and open a small live account and do a test again on live account. Okay? So you should always avoid typical newbie mistakes, searching for a holy grail. One of the reasons I'm introducing from time to time special webinars about different strategies, of course with Admiral Markets, but also I have introduced you with Price Action Trading School series of webinars which will last throughout the whole year. So learning to trade price action will probably keep you away from jumping from a system to a system. But if you want to trade indicator-based systems, then there is a bigger possibility that you will jump in from a system to a system than when you are only learning to trade price action. So the answer to your question is give a system a chance. And as Chris was saying to you today, do not be overwhelmed or angry if you suffer from some sort of drawdown, let alone a single trade. Trading is losing, trading is winning. Okay, but you need to be on a winning side. Do a deep analysis. Refer to trading plan webinars, which me and Chris did. Stick to the system you made money demo trading with. Open live account and trade small account. Accept your losses. When you are good with making from $100, if you can make $200, then you should definitely think about investing a lot more, guys. Maybe 10,000. Because it's same, you will just need to use bigger lot size, and money is, you see, you will see money. Because when you're trading $100, it's not good, but it's good for building up the account. I'm very proud if I make from $100 $300. It's not much, but it's you see how big profit is. I tripled the profit, so it's good. Try not to be influenced by big figures. $10,000, okay, it's okay, but do not think, okay, it's not the same as if I traded $100. The logic is the same, but instead of using 0.1, let's say you can use 0.3 or 0.5, right? This is one of my accounts which shows a good trend line. This is ascending trend line, but I made 2 mistakes. This is live account, and you see risk is too high. At this time, I use big risk, and the thing is, I forgot to put a stop loss because I was focused on other things, and that mistake cost me a drawdown on my account. Until this point, you see, this was going up with small peaks, but it was going up, right? And now big drop. Okay, I have identified this mistake as not having a stop loss. I always put a stop loss, but this time I forgot. That is my mistake. It's not market's mistake. I should have been focused on this, not on other things, and I lost this. And very fortunately, my account made, how we call this pattern, guys. Now this is the same as your account, your chart from time to time. How do we call this pattern? Do you recognize this pattern here? Everything is connected. I always repeat it. And I'm still waiting for answers. Do you know how this pattern is called? Some of you have been attending our webinars and reading our analysis. And when you see this, And on your charts, do you know the name of the pattern? No one knows it. Guys, this is V-shaped reversal. V-shaped reversal, right? And this is left, this is head, this is right. So on my account, this was inverse head and shoulders. And it happened. Look, this was the peak of my account here. This was the peak of my account. And then another mistake. A couple of days ago, I analyzed different pairs as I always do. But what I did, by a mistake, I just made a pending order. I was making some trend lines, whatever, and I mistakenly clicked right button on my mouse, and it made a pending order. And I completely forgot about pending order. Guys, completely forgot about pending order. And Australian dollar surged heavily versus yen. It was Australian yen. And I was watching Australian dollar, but I didn't, Australian yen, but I didn't want to make any pending orders. And I clicked right button, okay? It made automatically a pending order. And when I closed my platform, I forgot about it. It's called hardware mistake. And what happened? When I woke up, I couldn't believe my eyes. Look at this. And the same day, I used all of my trading experience to recover for that account. And I managed to recover almost every part of it. The account was 15,900, almost $16,000. And then it dropped to 11 or 12,000. And now it's something like 15,200. So I managed to recover. It's Camarilla MACD swing, scalp swing, so I managed to recover it, but believe me, this is not the way how we should trade. Yes, Jeremy is asking, did you have to place more risk per trade? Indeed, Jeremy. I'm always sincere with you and honest with you. I don't recommend doing that. But that's sometimes, you know, sometimes when you have a lot more experience and when you really know which pair to trade, then once in a year you can do it. But you need to be prepared for the worst. Always, guys. I didn't do this just because, well, guys, it took a lot of time to build the account to this point. Right? And I was thinking, well, if I don't risk now, when will I risk? I want to risk my profits, not my account, my profits. Initially, my account was 10,000. Okay? So I still had $2,000 to risk. So I put a whole risk in this $2,000. And it paid off. Of course, I knew what I was going to trade, really. And I took one of my setups was, if you remember, GBP dollar, then it was also euro dollar. Some of those trades, which I did the analysis, it gave me a good number of pips, a good amount of account has been restored. But the problem is, this mistake should never happen. So risk factor, liquidity. Now there are various risk factors you should be paying attention to, okay? And I will be mentioning it. Liquidity, guys. Liquidity is that there are a sufficient number of buyers and sellers at current prices to easily and efficiently take your trade. In the case of Forex market, liquidity, at least in major currencies, is never a problem. That liquidity is known as market liquidity, okay? But the thing is, that liquidity can be a risk, especially when there is volatility present in market. Trade management is also determined by how much trading capital you have available and how good is your risk management. That is what I have been explaining you. Your trade management. If you have money in your account, maximum loss available should be no more than 2% per trade. 2% loss trade would mean you can be wrong 50 times in a row before your account is wiped. That is why I'm teaching you to trade with 1% or 0.5%. So when there is a big risk in market, you need to lose 100 or 200 trades in a row to wipe your account. Guys, I'm teaching you to save your account. Okay? Leverage. Leverage is the use of the bank's or broker's money rather than the strict use of your own. Forex is leverage market. Okay? 1 pip loss in 100 to 1 leverage is equal to $10. Okay? So don't over leverage yourself. You have the ability to leverage, but do not over leverage. Exposure. While using reduced lot size is a good thing, it will not help you very much if you open too many lots, guys. Too many lots. It's important to understand correlations between currency pairs. If you go short on euro dollar and long on dollar Swissy, okay, you're exposed 2 times to the dollar and in the same direction. It equates to being long 2 lots of dollar. If dollar goes down, you have double dose of pain. You don't do it like that. You never open euro dollar long and Australian dollar short or vice versa. Because you will lose one of those trades for sure. Correlation between those currency pairs is highly negative. Minus 90, even more. That is why you should download Admiral Market Supreme and install Supreme Edition. It has a great tool called correlation table, correlation matrix, and you will see how correlation matrix will help you not to be double exposed to a single currency pair. Emotions are also a factor. If you want to revenge your trade, then it only has to do with your emotions, nothing else. Emotions are a huge factor in your trading. Do not be sucked into spiral of doom. And risk factor is hardware. That is my problem, which I did here. I forgot to remove my pending order. Also, you need to be prepared if your internet connection drops off. You need to have a mobile platform installed. Fortunately for us, mobile platform, you have it on Admiral Markets. You have it on Admiral Markets. Admiral Markets main website. It's in your trading room. You can download it, and you need to have reserve connection. In my trading office and home, I have 2 separate internet connections. One is cable, one is ADSL, and I also use my mobile phone. So if hardware failure happens or a powered outage, let's say blackout, I'm always safe. Also diversify pairs. Trade Japanese yen, Australian dollar, New Zealand during Asia session. Trade GBP, dollar, let's say euro and CAD during London Euro session. So you don't need to stick to dollar. In Asian session, GBP dollar will not move a lot. But Australian dollar, New Zealand will move. So diversify your risk. And finally, guys, I will open live chart. We are already over the time to show you basically how you can manage the trade. If you remember the analysis 2 or 3 days ago, GBP New Zealand, I told you that you could buy at this point. Okay? This is one of effective ways to trade. So this is your first resistance, right? We made a buy trade at this point. If you're not sure what I'm talking about, go to Admiral Markets website and read my latest GBP dollar analysis. So we basically opened our trade here. Let's say that you open 0.2 lots. When trade hit this level and break it, I closed the first part of the trade and the rest I put to break even. And the next is history, right? So that is how you can effectively scale out of positions. It's called scaling out. So you close the half of your trade at next level and the rest you put to break even. It's called enjoying the free ride. Okay? We will be talking a lot more about this in our future webinars, so be here with us. We are already over the time. Thank you for being patient. Thank you for your comments, and we are here with you to help you. Do not forget that today is FOMC, so do not trade now. Be prepared for a big volatility, and we will do reassessment of euro dollar and other major pairs during next week to help you with future movements. Thank you. We will be here with you soon, guys. Cheers.